Hi, I'm Donnie Hall, a partner at Kaplan Fox, and I will be your host as we present the 25 Red Flags Weekly series. Over the next 25 weeks, we will review a number of issues that are often the foundation for fraud and lead to litigation. Let's jump into week one. Red flags are in the footnotes. Fraud doesn't start in headlines. It often starts in the footnotes to a company's financial filings. Every investor has read thousands of financial statements. But let's be honest, most of the time we focus on the income statement, the balance sheet, and management's discussion and analysis, the glossy parts. The problem? That's exactly where fraud isn't hiding. The truth is usually buried 200 pages deep in the footnotes of a company's 10K. Let's start with the anatomy of hidden risk. Footnotes are the company's confession booth. They're where auditors, accountants, and management teams park all the things they don't want to focus on, such as changes in accounting policy, unrecognized liabilities, contingent exposures, or related party transactions that don't pass the smell test. You won't see fraud spelled out. You'll see it phrased like this: revenue recognition policy was revised to align with evolving industry standards. Certain transactions with affiliates were determined to be immaterial. The company reassessed its internal control environment. Each of those phrases sounds harmless, but they're not. They're breadcrumbs. And if you follow them, they often lead to a restatement, an investigation, or a class action filing 6 months later. Let's look at an example of how the issue plays out in practice. This is only a hypothetical example, but there are many similar real stories. A large pension fund, we'll call it Summit Capital Partners, took a heavy position in a mid-cap energy company. On paper, the fundamentals looked perfect. Revenue was growing. Debt was stable. Analysts were bullish. But tucked away in the footnotes of the 10K was a line that said, revenue recognition practices have been revised to align with industry benchmarks. No further explanation. 6 months later, the company issued a restatement admitting it had recognized revenue months before delivery, artificially inflating earnings to meet targets. The stock dropped 40% in 2 days. Summit's investment committee was blindsided. And the irony? Every warning sign was right there in the footnotes. They just didn't look. So, how can investors actually catch this? Here's the practical framework we use when we help investors flag financial reporting risk. 1. Track changes across filings. Compare footnotes year over year. If the language changes, even slightly, you need to ask why. Software tools can automate this, but you can do it manually too. A single word swap from no material weaknesses to certain deficiencies is all the signal you need. 2. Look for buried reversals. When companies quietly reverse reserves, defer costs, or move line items into other income, that's not efficiency, it's camouflage. 3. Watch for unexplained accounting shifts. Adopting ASC 6006 isn't a get out of jail free card. It's often used to retime revenue or smooth volatility. 4. Cross verify with management commentary. If the CFO says margins are improving, but footnotes show rising capitalized expenses, that's your gap. Fraud lives in those gaps. 5. Create a red flag law. Your analysts should maintain a running spreadsheet of companies that change accounting policies, restate earnings, or switch auditors. Over time, you'll see patterns, and those patterns are predictive. A key component is that fraud detection isn't just about skepticism, it's about curiosity. Investors often assume fraud is rare. It's not, it's under-detected. The firms that catch it early aren't lucky, they're disciplined. They read what others skip. You don't have to become a forensic accountant, but you do have to ask forensic questions. So here's the takeaway for week one. Don't skim, dig. Every 10K footnote is a story. Some are boring. A few are bombs. The investors who win in the next decade won't just be those who can model faster or trade smarter. It'll be those who see risk early. Next week, we're unpacking Red Flag Week 2, when growth moves too fast. If your portfolio teams are chasing high growth stories, you'll want to tune in. I'm Donnie Hall, and this is 25 Red Flags. See you next week.